Hi everybody, and welcome back to video number 6 in chapter 22. And before we continue with the solution for the direct method, put it into practice example that we left off with in video number 5, I thought I would show you what I've called the Rosetta Stone for the direct method. You'll find this in the modules. But I think it really does simplify how you would convert cash receipts and cash payments from the income statement to the cash portion of that. So um, take a look at this in the video in the modules, and I think you'll find it very helpful. I know I do. Okay. Okay, as we come back to the PowerPoint, when we left off, we were looking at the solution to this, and we were going to prepare the operating activities section of the statement of cash flow using the direct method with these numbers. Okay, so the statement of cash flows partial. Here is our cash flows from operating activities. And we have our cash receipts from customers. And we compute that by taking the revenue from fees. And we get that here. And less the increase in accounts receivable, the difference between $157,000 and $107,000, which is $50,000. And we subtract that to get to the cash receipts from customers. And those accounts receivable numbers are here, of course, in the previous slide. Okay. Now that we have that, we're going to compute the cash payments. Our operating expenses were $1,256,000 here. And we're going to subtract the increase in accounts payable, which is here. And that takes us down to cash payments for operating expenses of $1,206,000. We have income tax expense. We're going to add the decrease in income taxes payable, and we get that here. And that gives us the cash payments for income taxes. Okay. Notice again, we did not include depreciation, although given in the problem here, it was not pertinent to doing the direct method, where it is in the indirect method. All right. So, special problems in preparing the statement of cash flows. There are other problems that arise with some frequency that include the following. Number 1, adjustments to net income. Number 2, accounts receivable net. That means the allowance for doubtful accounts has been subtracted, as you would know. Number 3, other working capital changes. Number 4, net losses. And number 5, significant non-cash transactions. All right, depreciation and amortization. And we might as well throw depletion in there too. Amortization of limited life intangible assets and amortization of bond discounts or premiums. And those are adjustments to net income. Post-retirement benefit costs. A company must adjust net income by the difference between cash paid and the expense reported. Changes in deferred income taxes. Here, it affects net income, but has no effect on cash. Equity method of accounting. Net increase in the investment account does not affect cash flows. The company must deduct the net increase from net income to arrive at net cash flow from operating activities. Let's take a look at an illustration. The Victor Company owns 40% of Milo Incorporated. During the year, Milo reports net income of $100,000 and pays a dividend of $30,000. The question is, how would Victor report the investment in Milo in the statement of cash flows? Well, the solution, using the equity method, Victor's share of Milo's earnings and dividends are as follows. Here's Milo's net income. So we take 40% of that. That's $40,000. That's non-cash revenue included in Victor's net income. And then Milo's cash dividend, 40% of $30,000, which is $12,000. That cash dividend revenue is included in Victor's net income. So that difference of $28,000 net is the non-cash revenue to be deducted from Victor's net income. Therefore, Victor is going to deduct the $28,000 from its net income in the computation of net cash flows from operating activities. Okay, losses and gains. Here, a loss is added to net income to compute net cash flow from operating activities because the loss, like depreciation, is a non-cash charge in the income statement. And here, number 2, the company reports a gain in the statement of cash flows as part of the cash proceeds from the sale of equipment under investing activities. Thus, it deducts the gain from net income to avoid double counting. Once as part of net income and again as part of the cash proceeds from the sale. Okay, reporting a gain with the indirect method. Here is an illustration from the Lynch Company, which had land with a carrying value of $100,000 that it sold for $110,000, resulting in a gain of $10,000. And land is always a nice illustration because there's no adjustment for accumulated depreciation, as we don't depreciate land. The question is, how would Lynch report the sale of the land on the statement of cash flows? The $100,000 cash proceeds from the sale of the land is reported as a cash inflow in the investing activities section of the statement of cash flows. The $10,000 gain would be included in Lynch's accrual basis net income. However, since the gain is included in the total cash proceeds amount shown in the investing activities section, it should not be reported in the operating activities section. Therefore, the gain is deducted from net income to arrive at net cash flow from operating activities. This prevents the gain from being double counted on the statement of cash flows. All right, unrealized losses and gains. Here, unrealized losses and gains often result for investments in debt and equity securities. Those that are included in net income must be adjusted to determine the net cash flows from operating activities. Some unrealized losses and gains are reported as part of other comprehensive income. So since these unrealized gains and losses do not impact net income, no adjustments are needed. All right, let's take a look at the treatment of unrealized gains and losses using the indirect method. Here, this illustration assumes Target purchases the following three investments on January 10, 2025. Number one, the debt investment for $1 million is classified as trading. During 2025, the debt investment has an unrealized holding gain of $110,000 recorded in net income. Number two, debt investment for $600,000 that is classified as an available for sale. Okay, so during 2025, the available for sale debt investment has an unrealized holding loss of $50,000 recorded in other comprehensive income. And number three, equity investment of $200,000 in the stock of Grosh Company. The number of shares purchased represents less than 20% of Grosh's common stock. So during 2025, the Grosh investment has an unrealized holding gain of $15,000 recorded in net income. So, how would Target report each of these items on its statement of cash flows? Well, for number one, the unrealized holding gain of $110,000 on the debt investment increases net income, but does not increase the net cash flow from operating activities. As a result, the unrealized holding gain of $110,000 is deducted from net income to compute net cash flow from operating activities. Number two, the unrealized holding loss of $50,000 that Target incurs on the available for sale debt investment does not affect net income or cash flows. This loss is reported in the other comprehensive income section. So as a result, no adjustment to net income is necessary in computing the net cash flow from operating activities. And then finally, for number three, the unrealized holding gain of $15,000 on the equity investment increases net income, but does not increase net cash flow from operating activities. As a result, the unrealized holding gain of $15,000 is deducted from net income to compute net cash flow from operating activities. Stock options. Stock options do not affect cash, or cash is not affected by recording the expense. The company must increase net income by the amount of compensation expense from stock options in computing net cash flow from operating activities. All right, let's take a look at an example. The First Wave & Company grants 5,000 options to its CEO, Ann Johnson. Each option entitles Johnson to purchase one share of First Wave's $1 par value common stock at $50 per share at any time in the next 2 years. The fair value of the options is $200,000. Net income for First Wave this year is $600,000, and income tax rate is 20%. So the questions are, Alpha, what are the journal entries that First Wave would record in the first year of the stock options? And Bravo, how would the stock options be reported on the statement of cash flows in the first year? This looks like a good place to stop this video, and when we return, we'll take a look at the solution. Until that time, bye for now.